Hi, everybody. My name is Lynn Drake, and I am the president of Compass Commercial. And today I'm pretty excited to have Elliot Indig. How are you today?
Doing well, Lynn. Thanks so much for having me. Looking forward.
I'm excited. We're going to be talking about a lot of things about real estate and a little bit about title insurance and those kind of things today. So I'm excited about that. Let me give you a little bit of background about Elliot because he's got a lot of education here. He got his undergraduate from Touro College. Then he got his law degree from Wayne State University. He currently works with Adenbaum, Schloll, and Bloom. Did I say that right?
Adenbaum, Schlaff, and Bloom.
Okay, there you go.
Don't worry about it. All
And
good.
he works with title companies. He works with investors. He also works with advising small businesses on planning matters. So, oh, and by the way, you got to connect with this guy on LinkedIn. He's hilarious.
My claim to fame.
Your stuff is great. Okay, so let's get going. From your perspective, what is the most important thing in a negotiation?
So with a negotiation, I think many people focus on they think the most important thing is getting what they want and techniques and how to get where they need to go, and depending on the type of item that's being negotiated, the actual deal points. But the main thing in a negotiation and any really business deal or anything like that, or anything you really enter into, is to first, before you step into it, understand what your goals are, what you're doing.
Mm-hmm.
Because once you get sucked into that negotiation, and then the other side does this, and then you're like, oh yeah, well, I'm going to do this, and oh yeah, and before you know it, the goal is totally lost sight of. You're off track, and the reason why you entered the deal or you entered the negotiation is probably, if I would venture a guess, is to accrue some financial benefit to yourself
Mm-hmm.
and to further your objectives and further your goals. But if you get sucked into this never-ending vortex of, oh yeah, oh yeah, oh yeah, oh yeah, I'm going to do this, I'm going to do that, you're going to end up either not getting the deal,
Mm-hmm.
doing something foolish that you're going to regret, and your entire stated goal of entering into that in the beginning will have gone totally by the wayside. So it takes a lot of discipline. And what I suggest for most people, what a good idea is, always have that person who is not directly involved in that negotiation, in that deal. So you
Mm-hmm.
can say, hey, you're not emotional about this. You don't have a vested interest. This is what's going on. Am I off base? Is that person off base? What should I do? Just to sort of, so you can sort of step back out of that vortex and just really attack the issues from a very logical place to further your objectives and goals.
Great. And that's important. That's why they have attorneys and commercial realtors, right?
Yeah. No, for sure. I mean, those advisors, because like I'm sure you see it on your end also, because not you're representing as a commercial realtor, you're representing so many people, and for one person that might be their first and only deal that they're going to enter into, and for them this is their world. So every small thing can totally shake them up, take them, of course, off kilter. And with your experience, and you understand that, hey, you know what, this is what happens. They're just going to they're going to posture. Don't let it. So yeah, 100%, just like you said, keep them on the straight and narrow, get to the objective.
All right, we're going to talk a little bit about title work. Can you start though by explaining to the audience what title work is and why it's important when you're buying a building?
Sure. So title insurance is sort of, I'm going to think about the best way to explain. If I jump around a little bit, please forgive me. But just to sort of differentiate between, let's say, title insurance and any other type of insurance, the main difference is, the big difference is that with title insurance, it's a one-time payment. Okay,
Mm-hmm.
you make your payment at the time that you purchase the policy, which is typically at when a transaction occurs,
Mm-hmm.
the purchase, and that insures you for the life of the policy. until you sell it or whatever. Okay. Whereas regular, like with your health insurance, auto insurance, you got to keep paying to maintain your coverage. So at the time you get, so what is a title policy? A title policy, what does it cover? It covers a certain snapshot in time of the condition of title at the time that snapshot is taken. So to put that into a real life example, I buy the property. I'm buying a property. The title company will issue a report, and what's called a commitment. And the commitment is the title commitment will have on it a listing of all items of record dating back for, basically till the beginning of time, or really until the people started, began to keep records. And it will show, okay, there is an existing, it'll show, oh, there's a mortgage here, right? The person you're buying it from has a mortgage, okay? So that the lender's mortgage is recorded, and the commitment will pick up the recorded mortgage and say, okay, this is a mortgage on the property, and there are certain other, there are easements on the property, certain rights other people may have to use portions of your property. There may be certain tax liens on the property. Again, anything that's recorded in the Register of Deeds will, or should at least, be picked up in a title search. So now I'm going to buy the property. I don't want, we'll use you, I'm buying it from you, Lynn, right? I don't want the obligation of your mortgage to remain on the property when I buy it, right? I may have my own mortgage. I don't want to get stuck with two mortgages, right? So at closing, the title company there's two functions. They'll issue the policy, and they'll also do the ministerial closing work, typically in Michigan. That means that they will make sure that the mortgage, your mortgage, right? You are the seller. Your mortgage is paid off from the closing proceeds or otherwise, right? Because the closing proceeds are going to go into escrow with the title company. And then they're going to go ahead and make sure that those proceeds are wired to the mortgage company. And then they will go ahead and record the discharge of mortgage so that your mortgage is no longer of record on my property, and my property will just have my mortgage on it and certain other, easements that'll just, that carry over and stuff like that. So the policy ensures that snapshot in time. Okay. So right now the policy is saying, okay, Elliot Indig, you own this property subject to only two X, Y, and Z, these encumbrances, these items on title, whether it's my mortgage or anything else. Now, let's say a few years down the line, some guy comes knocking on my door and says, I don't know how this Lynn person got the property. I own the property. Here's a deed. I never transferred it. It's of record. Okay. And, normally I can, without, so what do I, what I do now, right? This guy claims he owns the house. I claim, this and that. I go look for Lynn. Lynn's gone. She left the country. She's on a cruise and she can't get back because of COVID. Right. And, so, yeah. And, I can't track her down. So again, obviously, so what do I do now? So I go to the title company, right? And I say, title company, apparently this property was not owned by Lynn. And again, it could be that you really thought you owned the property, because again, stuff happens all the time, right? You may have been sold this, again, this person may be lying. You may have bought the property from someone else who was messing around. Again, it could be any number of myriad issues. Okay. Again, the example is just illustrative. I go to the title company and I say, okay, this is what's happening here. Someone's claiming that I don't own the property. You ensure that I own the property. So the title company so I make a claim to the title company, and the title company will either accept or deny the claim based upon the language of the policy, just like any other policy of insurance. And this, is a most classic example, something that obviously they typically would cover. And they would first hire counsel on your behalf, meaning they would pay for counsel on your behalf. Okay, they would pay for an attorney, right? The attorney works for the insured, right? So I'm the insured, right? I have the policy in my name. The title company will pay typically for attorneys to represent my interest. The attorneys work for me, okay, because they're just paying for them to negotiate to figure out what's going on. Because sometimes, let's say the person filed a lawsuit, the guy who came knocking on my door, okay, filed a lawsuit of quiet title. So they hire attorneys, And then they go through either court process, and at a certain point, they'll either take the process to the end if the title company feels there's a viable something they can do to clear title, or if they are required to pay that person money or to pay me money because that person wants the property, and so they can pay. Whether they can pay, it's either going to be the policy limit. So let's say the policy limit was $200,000, so that's what I bought it for. I bought it for that, or the value of the property at the time, depending on a number of different factors. So that is what title insurance does. It allows the subsequent purchaser or lender, there are owner's policies and lender's policies, right? Lenders also get title insurance.
Right.
For instance, when you get a mortgage, when you buy a property, the lender will also get, because the lender also wants its interests protected as well. Because if there's another loan, then the lender can't foreclose because they're second behind another mortgage. So the same type of thing for lender, and that, in a nutshell, is what title insurance is and what title insurance does.
Okay. Can you share with us a couple of cases that you've run into that might be interesting?
So when I was sort of fresh out of law school, I started working for this firm called Socorro Law, and a lot of what they did was title insurance-based litigation. And so again, I've been doing it up until now, but I saw one thing there that was, pretty over the top. And I'm trying to remember the exact details because this was probably 8 or 9 years ago. I mean, 9 years ago, give or take. Anyway, the exact facts of the case, I don't remember. But to make a long story short, there was a fraudster who was serially going about and obtaining mortgages on properties in the names of dead people.
Oh, okay.
Yeah. So this person will go ahead and somehow apply for mortgages, people who are no longer alive, and abscond with the with the proceeds of those mortgages, or use them to buy other properties. And a lot of this was going on in the early to mid 2000s, when the real estate industry was flying high, and the title companies and mortgage companies and everyone, they were like printing money, because the market was just going up and up and up and up, and there were people that unfortunately were taking advantage of it. And when I say title companies, there were a lot of agents, right? Again, there were people who, it's like anyone, like they never think they're going to get caught. So they had, a lot of times you had these situations where you had an appraiser, a mortgage person, and a title agent, sort of all in cahoots. The appraiser would appraise a property. So the property is, let's say, worth really $100,000. Your appraiser would say it's worth $180,000.
Oh, wow. Okay.
They would submit the appraisal. It would get the mortgage approved. The mortgage broker would push it through, get the mortgage approved by the lender. And the title company would be on it, the agent would be on it as well. And they would just push all these things through, and they would just basically walk away with the cash. The title agent would be cashing in on on selling all these policies. And the appraiser would get a lot of appraisal work. And, again, it was obviously a scheme, but people were making so much money, and things were going so well, the market was going up, 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 that people didn't figure out what was going on, and people didn't see anything. Now, what happens when the market tanks? Okay, prices go down, market tanks, people are underwater on their mortgages, people stop making payments on their mortgages, and then lenders start to foreclose. What happens when lenders foreclose? They pull a title search. Now, the lender pulls a title search and on the property, the real legitimate lender, and one second, there is a mortgage here in the name of Deborah Smith with so-and-so social security number. We don't know about this mortgage. We pull up the social security number. She's deceased. She hasn't been alive for 25 years. And the mortgage was obtained 5 years ago or 10 years ago. What's going on? And so on and so forth. You had all these types of issues that were going on. And then so at that point, you had a real large number of these lawsuits coming up, because a lot of these issues on title are like time bombs. they happen at the time, right? There's something's recorded and no one knows about it because no one, for the most part, is doing a search of the Register of Deeds. And as long as everything is good, no one may ever find it. But the second either someone tries to refinance, buy, sell, or anything else, or until the property goes underwater, no one will know what's going on, and then all these issues are found out. And a very common one back then, the most common title issue that I was seeing for a while, and it still happens, is when there is a person who has a primary mortgage on the property, and then there is a second mortgage, a HELOC, home equity line of credit. And the home equity line of credit is very often a credit line that can be drawn upon.
Oh, okay.
Okay. And what happens is that they sell the property, okay, and the mortgage company properly would pay off the primary mortgage, pay off the home equity line of credit, but for whatever reason, they would fail to record a discharge of the home equity line of credit, the HELOC of that second mortgage. Now, what happens? The seller is still getting these statements from the mortgage company. You still have an account here, okay? You still have an account or whatever else, and it's still open. And the seller maybe falls upon hard times, or the seller is kind of nefarious, and then the seller will ask the bank to draw down on his or her credit line because it's still open, even though it's paid down to zero. He has a $100,000 credit line. So the bank says, sure, you have the credit line. And the bank starts to lend this fellow money up until it maxes out. The person stops making payments. The lender goes to foreclose. And then the lender sees, 1 second here, there's another mortgage on the property, or the primary mortgage, or the person who bought the property, their mortgage company, their lender looks to foreclose and sees that there's this HELOC there, right? Now this HELOC is in priority is before the primary mortgage because it was recorded first. And even though it was paid down to zero, right, since it was recorded first, everything tracks back, and that primary HELOC, which could be a mortgage of up to whatever it is, $20,000, $50,000, $100,000, can be in front of what was supposed to be the primary mortgage, a $400,000 mortgage. So that was something that was happening a lot. Again, because I think just people got sloppy because there were so many transactions, they were making so much money.
Yeah.
And, again, I mean, there are, there are a number of other examples, other different types of cases I can go into. It's up to you, depending on if you want to get to those. Some other things, totally up to you.
How was it resolved? How were those resolved? I mean, did the title, how was that resolved? I can't even imagine that. So did they have to run new title? Did they track down the people that did the illegal loans? Do you know how they solved all that?
So typically there's two stages. There's the claim stage, okay, which is right. Okay, now there's a problem. We got to rectify the problem. We got to protect our insured. We got to protect the property. So let's say the title company and counsel for the counsel for the insured determined that our insured mortgage or our insured owner's interest is subject to, is below the interest of this issue here of this HELOC, of the line of credit. Okay, so we have to get rid of that line of credit. So typically what they would do is that they would negotiate some kind of payoff with the holder of the HELOC, the lender. So whatever, let's say it's Bank of America, Chase, whatever it is, again, a lot of these lenders were swallowed up by other lenders, so it could be any.
Lost,
So,
right?
Right. So then they would go ahead. Right. And then they would pay off they would come to some sort of agreement, whether it's for the full amount or for a discounted amount, and they would pay the prior party, the party has priority, and they would obtain a discharge of the mortgage, and then the title is cleared up. Now, what happens after that is that title company has a right of subrogation, which means that they now stand in the shoes of their insured. They paid out in a policy. Now they have all the rights that their insured would have had against that third party, the wrongdoer, the person who
Oh,
drew
got
out
it.
the HELOC.
Okay.
So that's step two. Now, if the title company decides to go after that person to try to recoup its losses, it has the right to do so. And that's what I do. That's sort of the litigation I do. I do recoupment litigation, whether it's going after borrowers, a different owner. We can go after title agents also, for doing improper closings, making mistakes in the policies, and stuff like that. I apologize for the phone ringing in the background. There are I had a case, an interesting one, where the title company also acted. There was a law firm that was also the title company, and the law firm the attorney drew up the corporate documents of one of the parties, and the operating agreement said that in order to obtain a loan, both members of the entity, of the company, needed to consent to the loan.
Mm-hmm.
And then the same attorney in I forget, it was a guy or a gal, I forget, well, in that person's capacity as a title agent, closed a deal in which only one of the members obtained the loan against the company.
Mm.
So the person that drafted the documents, it was the same as the person who closed the loan. So we were able to sue the agent there, and for recoupment, because they knew what was going on, because they drafted the documents. So there are survey issues that could come up because of there's an encroachment that can get covered on the title policy of another property, even in one situation where there was a foreclosure, and the property was foreclosed on, and there was a new property owner because the property was foreclosed on. No one knew about it, and then the property owners didn't know about it because it was a loan that they never took out. It was from a previous individual that never got rid of it, and it was still of record. And then that person took out another mortgage because they were taking out a mortgage. So now they took out a mortgage on a property they didn't even own. So that's it. These things happen. Very small numbers, because if you think about it, excuse me, the amount you pay for the policy is not a large number, relatively speaking. It's a percentage of the price, of the purchase price. And of that number, a large part of it goes to the agent. The agent's commission is most of that amount, and only a fraction of it goes to the title company, the underwriter. So that should give you an inkling of, how many claims there are, how few claims there are in general.
What do you have a story about like any commercial properties that you've worked on where there's been litigation?
Yeah. So, at which stage? You're talking about title insurance litigation or general litigation?
Right,
Or
like in title insurance. Or do you see it more, let's ask this question, do you see title litigation more in residential or commercial?
residential, just because of the volume. There's
Because
many,
of volume.
yeah,
Okay, so you don't
there's
see it
more
as
residential
active.
transactions, and excuse me, typically in a residential transaction, chances are they're probably going to be the level of sophistication that is dealing with it is not going to be the same, because again, person who's buying a home, again, a home is very important. I'm not downplaying it, but that person will not necessarily have the resources, and I don't know even know if it makes sense to start, to hire, let's say, a white shoe New York City law firm, charging $1,500 an hour to do the work on it. Whereas by a larger commercial, yes, people still make mistakes. The largest law firms make mistakes. Anyone makes mistakes, right? But that'll contribute to it. But I think the main difference is that the volume of of those types of transactions. So I do have a story.
Okay.
Of a title issue, and this is also kind of wacky, very, very, very strange. That my client of mine bought two multifamily two large multifamily buildings in Southfield. And I don't know, a week or two after closing, a woman walks in, just like the case I gave you before, with a deed.
Mm.
I own the property. And she was a tenant of the property. Also, yeah, obviously, and she comes in and says, I own the property and I have his deed here. And the deed was basically her deeding it to herself on behalf of it. I mean, the whole thing was wacky, right? So obviously that's way out here in extreme, but that was something that had to be addressed. Very often you'll have a lot of times you'll have title claims that relate to taxes, unpaid taxes. So that could be commercial property also, right?
Yeah, tax lien.
Yeah, tax liens, something that are missed, and a lot of times in cities that have struggled with, have had struggles in the past with record keeping or stuff like that. A lot of times things don't show up. You know what I'm talking about, and
Yeah, I can think of a couple cities.
yeah. So yeah, so I mean, I also it didn't come to the situation of a title report, but my client was trying to sell a property, and there was the property itself, and then there was the parking lot next to it. So the property wasn't one lot, meaning a lot. When I say lot, I mean like a platted lot. Okay, like on the city records.
Right.
And then the parking lot was a second one. Then there was another one, and then there was like a third, I think.
So
for whatever reason,
plants, 4 pieces of land,
exactly.
4 tax IDs.
Exactly.
Yeah.
So for whatever reason, when my client decided to sell the property, we found out that my client owned the building, meaning was in my client's name, his entity's name. He owned the building. He owned the first part of the parking lot, but the second part of the parking lot was in someone else's name. And then the parcel after that was also in my client's name. So no one
in the middle, you got a piece.
Right. And that piece of land is useless because it's part of a parking lot for the apartment building. So in that situation, the buyer agreed to take we quick claimed it to that person, whatever. We have to go back and forth and try to track down. But things like that happen. Strange things can happen. And title insurance protects you in many cases for actions that happened before that were of record.
So was there a survey? Is that how they found out that the land wasn't all included? How did they figure that out?
That popped on the title commitment because
the title commitment.
Yeah.
Okay, that's
interesting. Right, because the title commitment showed, parcel X is owned by my client, parcel Y is owned by my client, and parcel Z owned by, we don't know who this person is. And why no one picked up on it when my client bought the property, I have no idea. But strange things do happen.
I like real estate because there's always strange things going on. Okay, what do you think is the most important part of a deal contract? No, the most important part of a deal contract is not in the contract. What does that mean?
So when I can draft the best contract in the world, and what people call an ironclad contract, which I'd say there's no such thing as that anyway, because there's always going to be something, some kind of exception, something that falls through the cracks. I mean, it's impossible to think of every eventuality and everything. That's just one label I'd like to just toss out there. There's really no such thing as an ironclad contract. Now, I draft a contract between two parties. We call them, Jim and Nancy. And Nancy, my client, is the most upstanding individual. She does everything the right way, and she's in the deal for the right reasons. And we enter into the deal. But Jim's not a good guy. He's not a good person. He is, he's up to no good. And Jim goes ahead and breaks the contract. He breaches the contract.
Breaches the contract. Okay. Which means that she didn't give him permission to
right.
do whatever he did, right?
Exactly, that he did something that he was not supposed to do pursuant to the contract. So now Nancy has to go ahead and sue Jim. Jim could have disappeared. Jim could know all the tricks and keep Nancy in court on this deal for years. Okay, so the point of this all is like this. People think that it's really step one of the contract. Step one of the contract is you have to know who you're doing business with. You need to choose that you need to know the people you're doing business with are at least within the spectrum of people that will abide by the law, do the right thing. Yeah, of course, there's different shades of gray in between, right? But you want to know that that person's in that general spectrum, and you have to do your due diligence, because you can go get down the line and you're going to be halfway to signing or even sign and the deal is closed and whatever that deal is, and then all of a sudden you realize whether it's a partner, whether it's someone, that person's a bad person and they're out to get you and they're just going to try to take your money and run away. At that point, it's too late. And yes, you can have the best contract in the world, right? But I can go ahead and I can sue that person. I can even win. Okay, but if that person shielded his or her assets, if that person ran away, if that person is uncollectible, if that person files bankruptcy and it's not fraud or not found to be fraud or whatever the case may be, I may not collect a dime.
Right.
So step one, always vet the person on the other side, whether that person is going to be a partner with you, whether that person is going to buy or sell something from or to you. That is step one. Ask around, ask people in the community, ask business people, ask your realtor, ask your attorney, ask. And a very underestimated tool is Google. Check that person up online. See if
great idea.
Right. See if he or she has anything that comes up. You'd be very, very surprised. So that's step one. I mean, that's the most important thing, because again, you can have the best rock solid contract, but if the person on the other side is not a good person, very often the good actor will be left holding the bag and with no or little recourse. So that's what I would always suggest in anytime a business deal is contemplated.
All right, that is great. Anything else that you'd like to share with us that you think audience would appreciate?
I think there could be any issues of real estate law. A lot of question I'm asked very often is regarding different types of entities, what entities are preferred for the purchase of real estate. A lot of that is tax driven. I mostly see LLCs because they're the most nimble in terms of corporate formalities, and it's only taxed once as a flow through. It's not taxed twice like a corporation. A corporation is taxed on the corporate level and on the second level also when it's distributed to the investors. Then also, the only other consideration with regard to that is that you have to keep in mind, if you have partners from overseas, many other countries do not recognize an LLC as something separate and distinct from a corporation.
Oh, I didn't know that. Okay.
So when that person is filing his or her taxes in their country, if it's an LLC, will look at it like a corporation and make sure that that person is taxed twice on the corporate level and on his or her personal level. So very often people who are investors from overseas will insist upon, or they should use, a limited partnership, because that, again, most countries that I've dealt with, people in other countries, a limited partnership is viewed as a flow through. So that's just the one, interesting thing that I've come across with respect to entities for real estate deals.
Great. Well, Elliot, why don't you share with the audience how they can get in touch with you if they'd like to hire you?
Sure. So I can be reached at my office number is 248-865-6500. I can be emailed at eindig@aidenbaum.com, or you can find me on LinkedIn, where I tend to make trouble every now and then.
He does. You got to see him.
Yeah, it keeps me young, keeps me entertained, keeps me out of trouble. And so that's how you can find me.